Welcome everyone. I have the pleasure of moderating the panels this morning, and our first panel is going to concentrate on firm leadership, and we have several. Well, I would say all of you are distinguished, and allow me to introduce them. Starting to my immediate left, to the audience's right, we have Steve Persky, who is the managing partner of Dalton Investments, which he co-founded in 1998. Steve oversees the Dalton Global Opportunities Fund, which from July 1st, 1999 to June 30th, 2006, had an annualized return of 12.6%, at which time they returned capital to investors because of the lack of high quality, alongside distressed opportunities. I think it's fair to say currently Steve's looking to redeploy some of that capital, and we want to get his thoughts on that. He has 28 years of fixed income experience, starting with credit training at Citibank, where he was a senior credit officer. He also worked at Solomon, where he traded high yield and international fixed income securities, both in New York and Tokyo. He was also, prior to Dalton, a vice president of Payden and Rigel, a local investment advisor where he managed institutional fixed income portfolios. And he has an AB from Harvard, where he studied majored in Asian studies, is also a active and loyal CFA charter holder here within the local community, right? To his left, we have Troy Spencer, Chief Operating Officer of Coast Asset Management, where he oversees the firm's non-investment functions. He rejoined Coast in 2006, where he served as Vice President and Associate Counsel. Prior to that, he served as Vice President and Associate Counsel for Amaranth. Before Amaranth, in 2005, he was at Coast in a number of capacities, and he initially joined Coast in 2002 as a General Counsel. Mr. Spencer then served as a convertible bond institutional sales trader, initially at Coast and its affiliated broker-dealer, Coast Asset Securities. He began his career as a tax attorney focused on cross-border tax structuring and private equity transactions. He has this is a long list here. He has a BA in economics from the Virginia Military Institute, a joint JD MBA from the College of William & Mary, LLM in taxation from New York University School of Law. Let's see. To his left, we have Bob Sinnott, president of Kayne Anderson Capital Advisors. Bob is the president and chief operating officer of the firm and is also the co-managing partner of the firm's energy private equity activities, which include origination and execution of the private investments in the oil and gas, oil field services, and infrastructure industries. Bob is also the director of several energy companies, including Plains All-American Pipeline. Prior to joining Kayne Anderson in 1992, Bob was a senior securities officer at Citibank's investment banking division for 6 years, concentrating in energy, high-yield corporate buyouts and restructurings, where he lived in Houston, Texas, and also concentrated in also LA. From 81 to 86, he served as director of corporate finance for the United Energy Resources in Houston. Bob began his career in the financial services back in 76 as a vice president and debt analyst for Bank of America. He has a BA in economics from the University of Virginia, an MBA in finance from Harvard, and has also served 3 years as a lieutenant on the USS Forrestal. Let's see. And last but not least, hi Stephen, we have Dr. Stephen Sapra from Analytic Investors here in LA. He's currently a portfolio manager on the equity team. Stephen is responsible for the ongoing research efforts of the U.S. equity-based investment strategies at Analytic Investors, as well as the day-to-day portfolio management and the trading there. Prior to joining Analytic Investors, Steve was employed as a senior consultant at Barra up in Berkeley, where he worked with lots of firms consulting in the areas of risk control and strategy implementation. He's a widely published author whose credits include the Financial Analyst Journal, the Journal of Portfolio Management, the Journal of Investing, and though we might not touch on it here, perhaps Adrian and Steve can talk about his work in the Journal of Sports Economics. He currently serves as on the board of the Applied Behavioral Finance Group. He's a chartered financial analyst and received his PhD in economics from Claremont Graduate University. He also holds an MA in economics from the University of Southern California and also a BA in economics from California State Polytechnic University, I should say, out in Nova. So, that being said, let's get into it. So, I'd like to start us off, and one of the themes that we had from a lot of the people here coming into this was getting your thoughts on your top leadership challenges and how some of that's maybe changed over the last 18 months. And Bob, I'll start with you, but hopefully could have everybody comment on broadly, how has your firm's approach changed to the marketplace over the last 18 months?
The main thing that happened is we're a niche investor in what we do, and we focused intently on where we were investing and hadn't focused very much on who else was investing in our industry. It's a little bit like we were a destroyer and we thought we were in an ocean. We found out we were a destroyer operating in a lake. Several of our competitors went under, and in so doing took down the value of the securities we were investing because they were in forced liquidation. So never again will we invest in an industry where we aren't watching what our competitors are doing and trying to enforce some discipline in our industry. For example, we're the largest MLP investor in this country. MLPs as an industry's cash flows went up 10% in 2008, and the value of their securities went down 50%. And it had nothing to do with the companies. It all had to do with the ability of the investors to hang on to their position. So the biggest change is we're no longer focusing solely on where we're investing. We're also focusing on what our competitors are doing.
Steve, would you care to, same question?
Yeah, I think that when we started in '98, it was kind of the heyday of hedge funds, and investors were very eager to access new strategies. I think the biggest change is that the relative strength and bargaining positions have changed dramatically, where investor capital is scarce, so it's a great time to invest, but it's more challenging to raise capital. I think investors are scarred from a variety of well-publicized events, and so there's more of a premium on infrastructure, on size. So those are some of the things that I've kind of noticed that have evolved over the last several years.
Got it. Troy, care to comment?
Sure. I just piggybacking on what Steve said, I think there's been a general focus on the distinction between the management company and the products. And I think that the events of '08 really highlighted that not all management firms are created equally. So we found ourselves engaging much more frequently in conversations around specifics to the management company, whereas I think prior to 2008 there was more focus on the products. So I think that in this environment it's very important for us to be able to demonstrably manage the risk of the management firm as well as the risk of the products.
Yeah, fair. And Stephen?
I think one of the main challenges, particularly in the quant space, is trying to manage expectations of employees and morale of employees. Basically from the crash of the dot-com bubble in March of 2000 through basically the middle of 2007 was a very favorable environment for quantitative strategies in general. And anybody who had a value-based strategy, a true value-based strategy, probably did pretty well during that time period. So I think a lot of employees of not just quantitative firms, but any sort of value-based firm in general, became accustomed to adding 200-300 basis points every year, and that's completely fallen apart in the last couple of years as value investing has fallen severely out of favor. And so a lot of employees of value-based investment firms find themselves in this new situation they're not accustomed to dealing with. And we see, as Bob mentioned, we see some of our competitors failing, perhaps those that took on too much leverage. And I think the challenge is trying to keep people sort of grounded in your investment philosophy and believing in the long-term nature of what you're doing, and helping them to sort of put their fears of what's happened the last couple of years aside.